Sentiment on Wingstop is flying all over the place. Last week, Piper Sandler double downgraded its rating on growth concerns, and today, Wedbush is out looking for 40% upside in the stock. Joining us for our call today is that Wedbush analyst making that bullish call on Wingstop, Setyan. Nick, great to talk to you again. You bring up a great point right off the jump in this note. Wingstop is one of the few restaurant companies that might actually see deflation this year. Talk to us a little bit about it.
Well, first, thanks for having me. Absolutely, wing costs are down precipitously from, second half highs of over $3 a pound. Now they're approaching $2. I think they're likely to go below $2. And given the percentage of their total food costs that wing costs entail, we're going to see pretty meaningful deflation in food costs for Wingstop this year.
Former CEO Charlie Morrison, Nick, he recently just left the company to pursue another opportunity, but he was telling us that their introduction of thigh bites is a big thing. Has it been a big thing for them, and has it helped to bring down their cost for their chicken?
I think it helped last year. I actually think, going forward where wing costs are, they may actually de-emphasize it a little bit in the near term, at least the franchisees may. But certainly it helped, on the margin last year in the second half when wing costs were at all-time highs.
And so, if we're seeing these costs come down, Nick, it's Julie here, whether we're talking about the wings or, if they're de-emphasizing the thighs for that reason, presumably they're not going to be cutting prices, right, for the consumers. So are they just going to take all of that in margin?
Well, they're not going to be cutting prices, but they're not going to be raising prices the way everyone else will be, this year. So I think that makes them a relative value going forward. And I think that's going to position them, really well, as the year progresses and even into 2023, even in a sort of slower consumer demand environment. But, bottom line is, at least in the near term, they're certainly not going to lower prices, and that should all be flow through to margins.
Nick, I was in my local 7-Eleven this past weekend, and they have that case by the register with their wings. And their wings look dreadful. 7-Eleven wings, they need to be completely remade. They looked as dry as a bone. It made me think, though, does Wingstop just have a strong hold on the wing market? I just don't see any other companies doing wings like they do.
Yeah, I mean, they call themselves a market of one. But, ultimately, we've seen some incremental competition through virtual brands. Applebee's introduced Cosmic Wings. Chili's introduced a virtual brand last year as well. That was part of the reason why wing costs went up as much as they did. But we just haven't seen a dent the momentum at Wingstop. So by and large, there isn't much competition on a national scale versus Wingstop.
What about Wawa? Somebody in our channel bringing up Wawa, right? Aren't they well known for wings too?
Well, again, on a national scale, right? We have a lot of regional competition in various areas of the country, but no one at their scale on a national level.
Nick, you obviously cover the restaurant industry. There's a lot of headwinds facing this space right now. Ongoing labor shortages, inflation. Are you concerned about how earnings have shaped up here for the sector in the first quarter?
I am concerned. I think there's incremental, headwinds both in terms of top line and bottom line. Incremental the gas price increases, higher interest rates. We'll see how that plays out. Maybe not necessarily in Q1, but as the year progresses. And then obviously you have incremental inflation from the war in Ukraine. Almost a third of wheat supply comes from those two countries, and a big percentage of corn. And those aren't just going to hit, things like flour and cooking oil and such, but it's higher feed costs. So it may actually translate to higher protein costs down the road as well. So those are certainly incremental concerns, and which is why, I'm gravitating towards these franchise names like a Wingstop, like a Dime Brands, for example, where we don't have to worry about incremental margins. And, those are two names that have actually held up relatively well, even in slower consumer demand environments.
Before we let you go, besides Wingstop, this big call that you guys are making today, are there other names in the space that you like into earnings?
Yeah, I like Dine Brands, that owner of Applebee's and IHOP. Again, almost 100% franchise model, not a lot of exposure to these, sort of inflation headwinds directly. And I mean, just as an example, in terms of how much visibility we have in terms of their profitability, they were the only restaurant that I covered that didn't have to raise incremental funds during the COVID, slowdown. So even though their restaurants were shut, they didn't actually have to raise incremental money. And so again, even in a recessionary environment, those are the two names that I like, Wingstop and Dime Brands.
I'll say this, Nick. Wingstop gets mixed reviews from our team here at Yahoo Finance, but as far as I'm concerned, they're savory, they're delicious, and I very much understand your call. We'll leave it there. Wedbush analyst Nick Setyan, good to see you.